Thanks everyone for joining us tonight for some more free education. I'm Brittany Piquel with Next Generation, and I'm happy to have with us on the line Oliver Somoza. He's the owner and CEO of Turnkey Property Pro. Oliver, did you want to say hi?
Hi everyone, and thanks for joining us.
Great. So we're going to talk tonight specifically about using self-directed IRAs for real estate investing and turnkey real estate projects. So I'm going to, as some of you may have already heard from me, if you've been on webinars before, I'm going to just gloss over a brief introduction to self-directed IRAs as an investment vehicle. And then I'm going to let Oliver do probably the majority of the talking tonight to talk to you guys about how some of these deals work and talk specifically about some of the trends in the Philadelphia and Baltimore markets. I know for anyone who's in the Mid-Atlantic region, this might be of interest to you if you're looking for investments that are more local to your location. So with that, we will get started. All right, so just a quick overview. In terms of self-directed IRAs and the role that Next Generation plays, we are a custodian and administrator for these accounts. We're not a financial planner, a brokerage. We're not financial advisors, so we don't advise or endorse or recommend any specific investments, but our job is just as important because if you want to do these types of investments, you have to have a custodian and administrator. So our primary goal is to provide pretty much neutral third-party service to these accounts. Majority of it is record keeping, bookkeeping, reporting, customer service, administration related to transaction processing. And importantly, as we're doing tonight, provide education related to these types of investments. So just a little bit of background on how the organization came to be. This is our founder and CEO, Jamie Raskolnik. So she founded the company in 2004. She wanted to make real estate investments within her own IRA, but she didn't know how to actually do it. So she actually joined this national network of third-party administrators for self-directed retirement plans. And then she led that from startup to over 150 million in holdings in 5 years. And then she decided that she wanted to break away from the national network, and she started her own independent firm. So in 2011, the company became Next Generation Trust Services, and we hold now over 600 million in assets. Her long-term goal for the company was to form a trust company, which started in July 1st of 2017. So we're over a year old as a trust company now, and then its sister firm, which is Next Generation Services, provides all administration for these accounts. As you can see, Jamie has she's been recognized as a leading woman entrepreneur. She's contributed articles to Forbes Finance, and we've been featured in Wealth Advisors Directory. So we're definitely out there in the industry. So two things that are important to have, as I just mentioned, for any self-directed investment, and we'll talk more about what that means, but it's just important to understand you need to have two components. One is a custodian to hold title to the assets within your plan, and then to produce forms for tax reporting. And it should be a regulated institution that's typically regulated by a banking commission or some sort of other, regulatory authority. And that should be audited, and they obviously have to provide reporting and certain information to that regulating authority. And then Next Generation Services, which is the administrator, which is the other piece that you need, provides client-facing customer service and helps with processing investment transactions and other types of administrative tasks related to retirement plans. So just a quick disclaimer, I mentioned it before, but we don't offer investment advice or approve any investments. That's what makes these a little bit different and unique from a typical brokerage account. If you're thinking about IRAs or other retirement plans you might have that invest in stocks, bonds, and mutual funds, but we do review for IRS compliance with regulations, and that's important to understand, especially with these types of investments as well, because we're talking about non-publicly traded alternative assets, and they fall under the direction of certain regulations that you need to be aware of if you're an investor that wants to get into this. Whether or not you're using an advisor, it would behoove you to educate yourself to know what you should and should not do in these cases, because nobody wants to upset the IRS, of course, but we all want to reap tax advantage investment returns, and we want to be able to plan for a bountiful financial future and a healthy retirement for ourselves. So what actually is a self-directed IRA or retirement plan? Well, they've been around since IRAs have existed since 1974. They basically are types of retirement plans that allow you to just invest in non-traditional assets. So instead of just being restricted to stocks, bonds, mutual funds that your broker-dealer might be obligated or tied to, allowed to offer you, it opens up the number of allowable investments that you can include in the retirement plan. And then obviously by doing that, you're able to keep your funds tax advantage or tax-free. So if you're investing in things like real estate or other types of alternative investments with personal funds and you're skilled and experienced in those areas, why not leverage some of your retirement funds to do something similar? And if you feel fairly confident that your investment returns are going to yield you a higher return than you would in the stock market, or you just want to hedge against some of the volatility and feel like you have more control over that return, then this is a way to diversify your portfolio. Not to say that you should put all your eggs in one basket, but definitely an option to consider if you're skilled and you want to invest in things that you know and understand with your retirement plan. So some of the types of plans that you can open that you can use to do these types of investments are retirement plans that you've probably seen already. They might even already have with other custodians. So traditional IRAs are for tax-deferred investing. They're the most common. You typically can deduct your contributions to these accounts, but when you make withdrawals after retirement, they're taxable at that time. Roth IRAs are probably, or essentially the opposite. Funds that go into Roth are considered taxable income for that year, and then those investment earnings grow tax-free, and then you're able to withdraw those funds after retirement without tax. They're not taxable, and then you're not expected to pay required minimum distributions. SEP IRAs and simple IRAs are for employers to set up. Some of the benefits to people that might be self-employed are that for SEP IRAs, especially if you're just a general contractor, if you're an independent contractor, you can set up a SEP for yourself and you can contribute more out of pocket to it than you typically would be able to with a traditional or a Roth, because it's driven by, that contribution limit is driven by the revenue that you generate or income that you generate from your business. And then other types of employer plans like solo 401ks. I won't get into the specifics tonight, but we can talk more in detail about those. And then the other last two, which are less common, but also really pretty valuable, are covered education savings accounts, which allow you to put funds into an account to save for a child's education tax-free, and health savings accounts, which we're all aware of, but I think there's a misconception that people don't realize you can use those funds once you've contributed them to an HSA to actually make different types of investments, to use them strategically to try to grow the value of that account. And obviously you can withdraw those funds tax-free for any medical expenses. So the contribution limits associated with these types of accounts, if they're self-directed accounts, it's the same as any other type. So if you have, for example, a traditional IRA with Chase Bank or with Fidelity, your contribution limits annually are typically $5,500 or $6,500 if you're over the age of 50. Those same exact rules apply to self-directed accounts. Again, the only difference is what you're able to invest in with those funds. So if you wanted to open a self-directed account, ways to get money into it to start doing what you want to do. You can make a personal contribution. We just talked about that. As long as it's within the IRS limits, it's essentially taking personal funds and depositing them into your retirement plan. Moving funds between like accounts. So if you already have an IRA with another custodian, and maybe it's a brokerage account and you're just invested in the stock market there, but you wanted to take some of that and put it into a self-directed plan to start doing something different, you could liquidate some of those funds. So I know that just to back up, we did look at the questions that people submitted when they registered and things that they said they wanted to learn from this webinar. And so we're trying to, and we tried to incorporate as much of that as we could into tonight's session. So we're going to cover as much as we can related to what you had asked for. And then if you have additional questions as they come up on the right side of your screen, there's a question box. You can enter those in, and we're going to talk through some of those questions at the end. So sorry, I didn't mention that earlier, but you're definitely welcome to submit questions as we go through this. So feel free to do that. But transfers from like accounts, you can liquidate stocks, bonds, mutual funds, etc., and transfer cash from another IRA to a self-directed IRA. And there's no cost from a tax standpoint to do that. If you have an old employer 401k, if you were participating in a plan and you no longer work for the company, you can roll those funds over into a self-directed plan. There's another process for that. And you can also move funds from, for example, a tax-deferred traditional IRA or 401k into a Roth IRA. That is considered a conversion. It's essentially like a rollover, but it is a taxable event because what you're doing is you're moving funds from a tax-deferred account into a tax-free account. So what happens when you do that is that you trigger a taxable event, and that amount that's moved over is considered taxable income for that year. All right, so on to the more interesting part, possible investments with a self-directed IRA. We're obviously going to talk about real estate tonight, and then you can see all the other options here. The world is kind of your oyster when it comes to what types of assets you can invest in with a self-directed plan. So get creative. Just know that some of the restrictions are life insurance and collectibles are really the main things that you cannot invest into with a self-directed IRA or any type of retirement plan. No one's going to allow you to do that. It's an IRS regulation, so it's never going to be allowed. But anything that falls outside of these categories is pretty much game for you to consider. So when it comes to specific real estate investment options, there are a number of different ways you can structure an investment into real estate, right? So even if you were just, think about this as if you were just doing it with your personal funds, you can directly purchase a property. In this case, though, if you're doing it with your retirement plan, it's going to be in the name of your self-directed IRA that you open. So you can either buy that property outright with cash that's in your IRA. If you don't have enough cash to buy it outright, you can finance it. You can get a mortgage, or you can get another lender to, to lend you funds for that project. There are some restrictions related to that. It has to be a non-recourse loan. We can talk about that in more detail if we have time tonight to get into that. And then if anybody else is interested in learning more about that, there's some information on our website related to some lenders that would offer them and what's important to know. And you can also, if you don't have enough funds yourself, you can partner with another individual. So you can personally partner your funds with your IRA, or you can partner your IRA with another buyer, a co-owner of a property, whether it's somebody else's IRA or it's someone else as a person and with their personal funds. You can also invest into mortgage notes, and you can use your IRA as a lender or a borrower, and you can execute a promissory note. So if somebody else was doing a real estate investment and they needed additional funding and they're looking for lenders, you can lend to them. You can structure it however you want in terms of how you want to be paid back your interest and principal. Some people do a balloon note, so they wait until the conclusion of the project. Some people ask for monthly interest and principal. Tonight, obviously, we're focusing on direct purchase of a property. We're going to talk about turnkey investing, so Oliver will get more into the details on that. But just so you understand some of the structured options, the last one is more like a private equity kind of scenario where you can use your IRA as an investor or limited partner in terms of investing into another company, another LLC. It can purchase private stock. And so there are a lot of different ways you can look at this. So keep your mind open. Just remember that all returns on investment have to go back into the IRA if you want them to be tax advantaged. So you can't personally take receipt of the investment returns, profit, etc. So something that's important to understand now, we talked about types of assets you can't invest in, certain ways that you can invest, and people that you can't invest with is also important to understand. So if any of these people were on the other side of your investment, it's not allowed with an IRA. So this is all outlined in the Internal Revenue Code. They call these prohibited transactions, which is basically any transaction, whether it's a buy, sell, lend, borrow, etc., between an IRA and a disqualified person. So disqualified persons are basically you yourself personally, your spouse, if you have one, ascendants, descendants, and their spouses, fiduciaries of the account, which might be a tax advisor, financial advisor, an entity that's majority owned by a disqualified person. So let's say you have a family-owned business. You wouldn't be able to use your retirement plan to invest directly with that family-owned business or an LLC that you might already personally have. Other certain types of business partners or people providing service to the account, which would be like a custodian or administrator. So the thing you want to ask yourself when you're looking at a potential investment is, who am I looking to maybe buy property from or sell it to or rent it to in certain cases? And ask yourself if those people or entities are considered disqualified according to these rules. So then there are other types of prohibited transactions. There are three main types you'll see here. Basically, the first one is kind of what I just described to you. The second one, which is important to understand, is the extension of credit, which refers to if you lend money or you extend credit between a plan and a disqualified person. So an example might be, and one of the reasons if you needed financing through an IRA, but it has to be a non-recourse loan, is that you can't get a mortgage with your IRA and then personally guarantee that mortgage. Because again, if you're personally involving yourself in that transaction, you're using yourself as a benefit to your retirement plan's investment, and that's not allowed per the IRS, unfortunately. But you can certainly get that non-recourse loan, and you can still use those funds to do investments with your IRA. And the last one is kind of gray area, but self-dealing is basically if you're thinking about doing an investment and you think that it's going to benefit you personally in the short run as well as benefiting your retirement plan, then it's probably not a good idea if you think it's a conflict of interest or you're double benefiting. So an example would be like investing into an LLC, somebody else's LLC, where you might be like a manager and your IRA is investing into it, but then you're also receiving compensation as a manager or director of that organization. You're obviously benefiting from your IRA's investment. So those are things that you'd want to look at, but also things that you would contact your custodian or administrator to ask about, because they should be well versed on the regulations to be able to help educate you and to tell you whether or not something would be allowed. So these are just some specific restrictions on real estate type investments. So just to put it in perspective, certain things like sweat equity is not allowed, exchanging property with disqualified people. You don't want to put a deposit down on a property with personal funds and then try to buy it with your IRA. You want to do everything from start to finish with the retirement account as the buyer. So that's very important to know before you even consider an investment. And there are a number of other things. We have a wealth of resources that go into more detail on the subject, but definitely just things to be aware of. So this is just an example in the simplest form of how a real estate purchase might work. Now, if you're going to buy a property in conjunction with a partner or an organization like Oliver's company, this might be a little bit different because they might be more involved in these steps of the process. But essentially, you want to find your property, and obviously, your IRA isn't a person. It can't negotiate a purchase contract. So it's okay for you to personally negotiate the contract, but any documentation that's signed needs to be signed in the name of the purchaser, which, if you're using an IRA, needs to be the name of your self-directed IRA in this case. And then you also need to make sure that you're keeping your administrator notified and you're sending any and all documentation to them, because in most cases you can't personally sign for your IRA. Your administrator, as a third party, has to sign for it on behalf of your IRA. So you want to make sure that you're aware of the process before you get into a specific investment. But you would be able to, again, do your due diligence related to inspection and title search, things like that. Often we work with title companies to make sure that, whatever needs to be provided to them is provided from us, and that we're working with you to make sure that we have all the right information. Closing documentation as well. escrow instructions, we're actually the ones that are sending funds or releasing the funds out of your IRA. So that's important in terms of letting us know what needs to be done. And then, again, all documentation in the name of the IRA. And then essentially at that point, your IRA would own property, and you'd be able to either, you can manage it yourself, but you want to be careful as to how much you're doing because you can't contribute sweat equity. But you can also use a property manager, which is kind of best practice, I would say, and most people that have multiple investments are using a property manager. So you want to be somewhat removed, and you want to remember that this property is for investment purposes only. So if you wanted to do something like this, the first step would be opening a self-directed IRA. Once you fill out an application, it takes about 1 to 2 days to get it open. Then your retirement plan has its own name and account number. Then to fund your account, you need to get cash in there. We talked about some of the ways that you can do that. You would work with us as well to get that rollover done, that transfer done, that contribution done. We'll tell you what you need to do to make it happen. And then once your account is funded and you're ready to make an investment, you would again make sure you let us know, contact us. There's some paperwork that would need to be completed internally for us, as well as supporting documentation that we would need to look at. So I'm going to talk about that now. Internally, the things you see on the left side are basically going to just tell us, give us contact information for the closing agent, property description, percentage of ownership that you plan on having of this property, if your IRA is going to own it 100%, or if someone else is going to be involved in the purchase. And then the offer, contract, and all the closing documents have to be vested in the name of the IRA. We would need a copy of the unrecorded deed prior to the closing. And the deed would have to contain the proper legal name of your IRA, and then we would sign on behalf of the IRA. And then once the deed's been recorded, we would need a copy of that as a follow-up to maintain on file for your account, because we're holding nominal title to these assets. So we have to be able to report to the IRS on anything related to the assets owned within your IRA. And then lastly, proof of insurance, anything, again, needing to be signed on behalf of the IRA would have to be marked read and approved by you, but we would have to actually sign on behalf of the account. And then just a visual depiction of how this would all work. You as the account owner would contact your custodian and administrator to take funds from your plan that you've already set up and funded and move them into an investment. So we would do that for you. So you can see how we are kind of removed physically or logistically from the process. And then once that yields a return, it goes directly back into the plan. Just remember, everything that goes back in there, if you're selling a property or you're renting it out, any of that income is not subject to capital gains tax because it's in your retirement plan. So it'll continue to sit there. You can grow it over the years. You can reinvest that cash, whatever you'd like to do, but those are your retirement funds. You're entitled to them when you're ready to make or take distributions out of your account. Depending on the type of account that you have, they may or may not be taxable at that time. But again, this is a way for you to do what you know and what you're good at, and to do it using a retirement plan to benefit your financial future. So with that, I'm going to, I know I kind of sped through that, sorry. Just so everyone sees real quick, if you want to get more information, we have a blog online. We contribute to it weekly. We have a YouTube channel. We're on all social media. The website has a ton of information, and we're happy to have one-on-one conversations with anyone that has specific questions. But for the sake of time, I am going to turn it over to Oliver, and I'm going to let him talk you through the real estate specific portion of the session.
Okay. Hi, everybody, and thanks again for joining us on the webinar, and thank you to Brittany and Next Generation for having me. So basically, I want to talk today about my company, which is Turnkey Property Pro. We are basically a provider of turnkey real estate investment properties in the Philadelphia and the Baltimore markets. And basically, very simply, what we do is we help investors locate investment properties in those two markets. We will perform any necessary rehabs to those properties. We will actually put tenants into those properties, and we will manage those properties for our clients. So we do that in Philadelphia and Baltimore, and they're both kind of very exciting markets. I'm just trying to pull up my screen here, but oh, here it is. Okay. So a little bit about myself. I've been in the real estate business basically for the last 18 years. I got into it when I was basically 18 years old. I did every sort of facet of this business. I started out in the brokerage business. I'm actually originally from New York. That's where I started my real estate career. And very quickly I went from, brokering, just normal sort of apartments, to actually working very in-house with the bigger landlords and developers in New York. And in those functions, I did everything from not only managing their portfolios, but doing property management, and then actually getting into construction and development. I basically, my old boss in New York is probably now the, biggest and the most active condominium developer in New York. When I worked for him, I was basically, his head of construction and manager of all of his properties. And in that role, the minimum project that I was doing was $150 million, new ground up construction buildings. So I've done everything from basically, renting apartments to property management to constructing big expensive buildings. And basically how I kind of got to Philadelphia was, I'd spent all this time in New York sort of building for, other people, and kind of got to the point where I wanted to start developing for myself. And as I'm sure everybody knows, New York is sort of wildly expensive, and nobody was going to lend me, $50 million to go buy my first building in New York. So I started looking for a place where sort of normal people could invest. And one of the big things that I was sort of concerned with is, the demand for property. So, after a bunch of searching around, I came to Philadelphia. I kind of fell in love with the city for, a multitude of reasons. And I've been here for the last 6 years, and I, buy these properties actually myself. And then, there came about, basically a lot of people who, would love to own the real estate, but, they may not be geographically located near Philadelphia or Baltimore, or they may not be able to handle the day-to-day of the business, whether it be, finding the property or, managing construction of the property or dealing with the tenants. And so here is where basically, Turnkey Property Pro came from as well. I wish I could buy all of these myself, but, I can only buy so many, but I will also, kind of leverage my experience and develop for other people. So that's basically a little bit about, myself, and a little bit about, the company. Basically, what we try to do is we will work with investors and figure out what their sort of goal is with all of this, right? Whether they want to buy, a property that might appreciate quickly, and maybe might have a little bit less cash on cash return, or, some investors, they really like very high cash on cash returns, and they don't plan on really selling these assets. So we try to really work with our investors and figure out what their goal is. And then we basically will go out there and try to find the best available deals that, meet our investors' criteria. So we basically, one of the really nice things about Philadelphia and Baltimore is a couple different things. So number one, the properties are affordable, right? Most of our properties start at about $85,000. They go up to, on average, about $150,000. Both Philadelphia and Baltimore are primarily a 1 to 4 family market. So if you've ever been to Philadelphia, and you go outside of, the center of town, you'll realize that the majority of the investments are sort of these row house type houses, which are single family. So there's not a tremendous amount of, bigger multifamily buildings here, but certainly there's a very good opportunity, I think, in both cities to, acquire properties inexpensively that also cash flow, pretty heavily, and in a lot of circumstances will appreciate over time pretty significantly. So basically, how the process kind of works is we will, if you were to get in contact with us, we would basically have an initial discussion with you. The properties actually move very, very quickly. So our list is kind of constantly changing. So what we like to do is sort of have an initial discussion with our client and basically, figure out what their long and short-term goals are with this. We will then go out and find appropriate investment properties that our clients will be able to purchase themselves. So basically, once we've identified a property, then we will actually move to close on that property. All of our properties actually go through a title process, so to make sure that the sellers are really the sellers, that the property gets delivered to our investors with clean title. You get over $100,000 in actual title insurance when you close on one of these properties. During that time, we will actually sign construction agreements if there's any necessary construction to those properties. You will also sign, and if you're using your IRA, you will sign, with your IRA, basically buying these properties, and then the properties will go through title, and then typically we will begin the construction process. So basically, in a lot of these properties, they are, for the most part, row homes, 3-bedroom, 1-bathroom properties. Our general business model is to buy assets that need construction, because there is where you're able to basically get very good deals and add value to those properties. Typically, we try to buy properties, anywhere from, on an average, anywhere from as cheap as $30,000, and some of them, depending on what you're buying, get more expensive than that. But those properties obviously need, a significant amount of work. So as a part of our construction process, basically, what we're trying to do is put these properties in the best position to, not have any short-term kind of maintenance. So we're doing, new roofs, all new electric, all new plumbing, all new HVAC. We're doing all new windows. We're doing all new framing, all new insulation, all new drywall. We're doing all new kitchens, all new bathrooms. And so we're making sure that the major facilities of the building are new. We do actually all of our work with permits and, licensed and insured general contractors. And typically our construction process takes, if it's more of a, simple single family, it's about a 120-day construction process. If it's, maybe, sometimes we have duplexes and triplexes, which have, multiple apartments. Those construction processes can take a little bit longer. It usually takes about 6 months for one of those to be completed, but we would obviously advise you very specifically about the property that you're buying, what to expect as part of the construction process. And basically, we will then go through and construct the property, and go through all of those things. Now we do, we pretty much touch generally, we're generally taking buildings that are existing, and rehabbing everything with the interior. So we're not generally doing new ground up construction. In Philadelphia and in Baltimore, I think it makes a lot more sense to buy some of the existing structures. But, we certainly are capable of doing new ground up and can talk about that. But generally, our process is rehabbing the existing properties. And again, we're touching 90% of those buildings, 95% of those buildings, but we're also renovating them in such a way that they are friendly to landlords. So basically, we're doing rental grade sort of finishes, and you want those finishes just in case, if a tenant, were to damage one of the houses, it's not expensive to replace those things. And we have all sorts of kind of protections against that. I think that's one of the big concerns when people sort of buy these properties as well. Are my tenants going to damage it? We put our, both our tenants through a very rigorous, sort of qualification process. And we also take 2 months security deposit from our tenants. So that, kind of helps allay, even if they were to damage the property, usually any damage would be covered under that tenant's security deposit. Once we basically finish construction, we will actually then go put the property on the market. In Philadelphia, we generally do what's called all free market rentals, which means that, we're not doing any kind of Section 8 type programs. One of the really nice things about Philadelphia is that there's a 2.9% vacancy rate, which is very, very low. It's actually amazing. And a lot of the properties that we deal with, you will literally advertise one of these properties and get 40 calls a day from people who are looking to rent these. That was also a big kind of deciding factor for me, about Philadelphia is that, it's, I think, the 6th biggest city in the country. There's over 2 million people here. There's 92 colleges and 115 colleges and universities. So, for me, I think the demand is there. Baltimore is a little bit of a smaller place, and we'll talk about that in a little bit. Now we're on the BRR model slide, and it's important to understand the BRR model because most of our investors actually follow this model. So I want to explain it to you, but just as a disclaimer, I don't think you can use this process with your IRA, but you can certainly use it if you are using your own personal money to buy these properties. But it's just important to understand kind of basically what BRR is. Basically, it's the buy, renovate, rent, refinance, repeat business model. So most professional grade landlords, instead of, let's say, buying a house traditionally where you go and you put 25 or 30% down on a finished house, and let's just as an example use $100,000 house, and let's say that $100,000 house was completely finished and you were to go through the traditional method of putting your 30% down and financing the other 70%. The problem with that business model is that basically, let's just say you had $100,000 in investable capital, and let's say I had $300,000 houses that were done, and you could go get financing on them. You would put your 30% down on each one of those 3 houses, but the problem is you would actually have to save up another $100,000 to be able to buy again. So what most professional landlords, instead of doing that, what they'll do is they'll using that same example, let's say you had $100,000 to invest, they might buy one property, that basically, let's say, needs some work. So let's say the property is $40,000, it needs to be completely rehabbed. You can perform a renovation to it for $60,000. Well, once that property is actually done, that property should actually be worth more money. So we typically try to, as a company, we work specifically only with investors, and we sell our properties below the current market value so that, number one, our investors have built-in equity. And, it depends a little bit on what kind of property you're buying, but typically we try to get about 20, 25 to 30%, sell it to our investor clients, 20, 25, or 30% below the current market value so that they can follow this sort of BRR model. So basically going through that same process, let's say you bought the property, you put the renovation, now you have a property that's worth $130,000. And typically these investors will buy them in cash because typically, these properties that are shells, they're not really financeable going into them basically. So you have to kind of buy them in cash, and you kind of have to, put the construction in cash. But then once that construction's been completed and the property is worth now, 25 or 30% more, then what our clients will typically do is refinance those properties. So they'll go to the bank and they'll say, okay, now I have a fully renovated property, and the bank will give you, 70% of the new valuation, which would be, let's say in this example, 130,000. So basically that enables you to cash out 70%, which is approximately about the same $100,000 that you would have put into it. So what that enables you to do is basically recoup all your capital. And in your first property, you have, a tenanted property with a mortgage. Typically, our mortgages are no more than 40% of what the actual rent is. So basically, you'll have a tenant in there who is not only paying your mortgage and your taxes and your insurance and all of that, but you're actually additionally cash flowing positive on top of that. And then you have all your original capital to recycle into the next deal and the next deal and the next deal. And that's how these guys go from sort of 1 to 100 houses. So most of our investors kind of follow that business model, but certainly we work with investors who have different goals, and that's why it's very important to talk very specifically about what you're looking to do and sort of how we can kind of help you in that process. Okay, so talking a little bit about property management. I have 20 years experience in property management. I think that's one of the things that really kind of separates me from my competitors, let's say, is that I put a real importance on property management. I really try to treat these properties as if they were my own. In fact, with other people's investments, I take them even more seriously than my own. So we typically will qualify all the tenants. All of our tenants have to have credit reports done. They have to meet certain credit requirements. They meet certain income requirements. Typically, the tenants need to make at least 3 or 4 times the monthly rent combined. We are actually partners with 2 different management companies for longer term management. One is Anchor Realty in Philadelphia. They have over 900 units under management. They are basically the best property manager that I've been able to find in Philadelphia. And in Baltimore, we are partners with a company called Reveal. And they are a smaller management company, but a very, very experienced developer within the Baltimore market. Unfortunately, I can't be in 2 different states to change light bulbs for tenants. So basically, what I will do generally when we finish one of these properties is that I or my company will basically place your first tenant, make sure they're qualified, make sure they're somebody who, I would personally put into these properties. We perform all the background checks. We actually give our clients final approval. We'll come to you and say, hey, look, we have X person or X several people who want to lease the place, and you will get the sort of final decision. And then once the tenant has kind of moved in, we will give the property to either Anchor or Reveal to do the sort of longer term property management. They are more than professionals within their respective fields, but they also report back to us so that if there's ever a problem, we, Turnkey will know about it, and then we can advise you on sort of how to handle that process. I mean, just very quickly, one of the really nice things about Philadelphia and Baltimore is that even if you were to, let's say, get an eviction, the eviction process is very quick and very inexpensive. So your average eviction will take in Philadelphia, usually the whole process start to finish is between 60 and 90 days, which is in comparison to New York, you could spend 6 months before you even get into court. In Philadelphia and Baltimore, it actually moves very, very quickly. Typically, those evictions will cost anywhere between $750 and $1,500. So it's not a cataclysmic event when it does happen. I'm certainly not sitting here and saying that, you will never not experience an eviction, because that's, is probably not possible. But I certainly, will put all of my 20 years experience and all the might of our property management companies and their experience to make sure that you are not in that position. Okay, so let's talk about Philadelphia and why I like Philadelphia. I mean, Philadelphia is the sixth largest city in the country. There's over 2 million people, 6 million people within 10 miles, 15 colleges and universities. So for me, looking at Philadelphia, if you look at all the major cities on the Northeast coast, you have New York, you have Boston, you have Washington, D.C., and all those cities are super, super expensive. They're, basically in a lot of ways becoming unaffordable for most people. So, for me, Philadelphia is very exciting because it's basically an hour and a half away from New York, and you can buy properties for $100,000, where I don't think you can buy a parking space in New York for $100,000. Here you can get, whole buildings that pay you rent, and, our properties typically have, pretty nice cap rates. I mean, typically, in Philadelphia, you can get anywhere from 7% cap rate to, it's getting, with the city kind of appreciating as quickly as it is, and the demand for property is, as busy it is, the returns get a little bit less and less. But I think that the city in general, it's just too cheap, basically, for a major city. So it's actually, Philadelphia is the #1 city in the country where millennials are moving, so people between the ages of 18 and 35. And I think part of the reason is because in Philadelphia, you're very close to New York, you're very close to D.C. You can actually, there's a whole community of people who actually will take the Amtrak, which you can get to New York in an hour and 10 minutes, that commute actually every day. So they have their New York salaries, but they can live more affordably here in Philadelphia. So again, another big thing I think to note about Philadelphia is the low property taxes. Our average property has a property tax of about $800 to $1,200 in property taxes per year, which is extraordinarily low. Like when I've looked in, other cities and other states, as an example, New Jersey is a good example. You have basically, you can find houses that are sort of in this price point, but the property taxes are 5, 6, 7 times more expensive. So you can basically, as a rental landlord, you can spend, half your year of your rental income just to pay your property taxes. So one of the big nice things about Philadelphia and Baltimore is that historically they've had very, very low property tax. So for cash flowing rental landlords, I think it's a big positive. Here is another nice little chart about sort of some of the different neighborhoods in Philadelphia, and we can kind of talk a little bit about the neighborhoods and kind of how we select properties. We break down properties into, let's say, A, B, C, and D neighborhoods, right? So in Philadelphia, and I'll just use that as an example, an A neighborhood property, usually those properties are kind of, in our view, sort of already done. Typically, they will start at $500,000 and go up from there. And those properties tend to be in the nicest neighborhoods in Philadelphia. But the problem with those is, maybe if you were to come and buy, you would buy and live in one of these and hope for appreciation. The problem is, from a cash flow perspective, they basically rent for what it costs you in a mortgage. So you're really kind of at a break-even point in terms of rental. So what we like to look for is, not only, we like to basically invest very close to where the A neighborhoods are. Those are typically our B neighborhoods. Our B neighborhoods tend to be very close to our A neighborhoods. And there's a very good argument for why, the housing prices will increase. Just as an example, one of the areas or a few of the areas in Philadelphia that we like, one is West Philadelphia. West Philadelphia goes 33 blocks. It's the first neighborhood to the west of Center City. It's also called University City. That's where the University of Pennsylvania is. That's where Drexel is. That's where Wharton is. That's where the University of Sciences is. So basically 150,000 students and university-related professionals go to this one area of Philadelphia every single year. And basically it spans 33 blocks. Once you pass, it goes from 30th Street to 63rd Street. Once you pass 63rd Street, you go into a different county called Delaware County, where you have the same properties at the same prices, but the property taxes are, again, 7 times more expensive. So both the investors and the renters and the home buyers kind of like to stay on the Philadelphia side. And basically just a small story about West Philadelphia. It used to be that, basically from 30th to 39th Street, it was, the more A neighborhood. That's actually now over the last 15 years extended all the way up, even to really 63rd Street. But around 52nd Street, you can get a property. You can still buy a property, let's say, from anywhere from $100,000 to $160,000. And then if you go to 51st Street, all the houses are $300,000-$400,000. And as you go further south into the city, they get, into the millions. So basically, the idea is that, if you invest in these basically only 15 more blocks that you can go, as the more expensive part of, West Philadelphia gets more and more expensive, people are pushing north and north and north, and the property values are rising. So that would be a very good example of a B neighborhood. B neighborhood is typically where you can, buy stuff where you can get some built-in equity into it. We also do what we like to call C neighborhoods. C neighborhoods, typically, the prices of properties are cheaper than the B neighborhoods. They tend to be like good working class neighborhoods. But, they may not have the same, equity that a B neighborhood might have. So I have actually clients from all 50 states and 22 different countries. So a lot of our American investors who look to get financing on these properties, they tend to prefer our B neighborhood properties because they can sort of do that BRR business model. Our foreign investors typically cannot get financing at all on these properties, but even still for them, it makes sense to buy them in cash and just leave it because the properties actually return quite a good return for what they are. So actually we have a ton of foreign buyers who are buying these and just holding them in cash, and they typically like the C neighborhood properties because they tend to be cheaper and they cash flow pretty significantly. Finally, a D neighborhood would be, sort of that very heavy drug and crime neighborhoods. We don't go into those neighborhoods, just because they become sort of a management nightmare. So we try to focus on where, we think the trends are. And that's kind of how we break up all the different neighborhoods. Here's, another chart about how, basically home sales have not hit their pre-recession high. One of the nice things about our properties as well, most of our rentals are sub $1,500. So basically, most of the rents that we're getting typically are between $1,000 and $1,500 a month. And in that price point, good, bad, ugly economy, people can afford that. In fact, back in 2008, when a lot of, landlords were losing their shirt, the type of properties that we focus on, because they're affordable, the first people to move are actually from the A neighborhood. So the caliber of tenants actually got better, in some of our properties. So, obviously, I can't predict that they will never be hit by a recession, but our properties actually are affordable for most people. And so actually in recessions, they kind of do very well. So, okay. So this is just some more facts about some of the, basically the housing prices gradually going up in Philadelphia. It's very exciting to me because I actually, I grew up in New York in the 80s, and I kind of saw a lot of the neighborhoods change, like Brooklyn and Harlem. And, I was involved actually when I was doing development there and a lot of the development of those neighborhoods. And for me, it's very exciting to see, Philadelphia, because it reminds me of basically New York City in the 80s, like where you can still, buy property, and it's very exciting because there's all restaurants opening up, and the property's getting fixed, and there's still opportunities to buy things here. So anyway, so now we go into sort of an example deal. This is actually a property that I own myself. And basically, this is kind of what your typical sort of row houses will sort of look like. They're typically 2 stories, sometimes 3 stories. Again, they're typically, usually there'll be a living room, a dining room, a kitchen, and then on the ground floor with, a little backyard or front yard. And then upstairs, you'll have typically 3 bedrooms and a bathroom. This particular property has 1.5 bathrooms, where we put a half bathroom downstairs, and then obviously has a basement. But basically, this is sort of, kind of a typical deal that you can get. So the purchase price is $55,000. Construction costs were $70,000. The closing costs were $3,000. And by the way, we should just touch on closing costs really quick. On average, usually we like to say that in Philadelphia, the closing costs for one of these properties are, between $3,000 and $3,500, and it's an average because basically, whoever the buyer is responsible for paying those closing costs. So when you actually start to look at some of our investments, that will always be an additional expense, not only of the actual property, but also the construction, but also the closing costs. And that covers a 2% transfer tax that buyers basically pay, and also covers all of your title work expenses. And then it actually also covers, depending on what time of the year you close, but your property taxes up until the end of the tax year. So it varies a little bit. In Baltimore, it's actually a little bit more expensive. It's about $4,500, and that's because in Maryland, all title work has to be done by attorneys. So they actually charge more money for that. So anyway, just wanted to talk a little bit about closing costs, but in this particular deal, we were able to rent it for $1,350. There is a property management fee of 10%. That's what is kind of the industry standard, both in Philadelphia and in Baltimore. So you should expect to, you don't have to, but you should expect to pay a property manager. The property tax is about $1,200 a year, so it's $100 a month. The insurance for the property, which is also an expense that all the properties have to be insured. So that's about $80. It's about $960 a year. So you have a 9.7% return on this particular property. So it cash flows kind of nicely. This particular house is in an area called Germantown in Philadelphia. It's actually one of the oldest neighborhoods in the country. I mean, they have houses there from the 1700s. And it's very close to 4 different neighborhoods. East Germantown, where this is located, West Germantown, East and West Mount Airy, and Chestnut Hill. And just to give you an idea, the average cost for a house in East Germantown will be anywhere from $8,000 to $200 or $250. In West Germantown, they typically go from $150 to $500. In Mount Airy, they can go anywhere from $150 into the millions. And Chestnut Hill is actually one of the most expensive neighborhoods, and you have anywhere from $3 to $4 million houses there, up to $25 million houses there. But all of these neighborhoods are within a 5-minute drive of one another. So basically, a lot of people are actually now investing in East Germantown because you can still get good deals there. So the properties are going up. Okay, so let's talk about Baltimore a little bit. Baltimore is, I think, it's a smaller town, right? So it's smaller than Philadelphia. There's about 600,000 people there. And basically, with the prices of properties kind of rising very quickly in Philadelphia, I have a lot of investors who they never want to sell these. They're looking for sort of higher cash flow. In Baltimore, if I were to look at it sort of globally, if maybe Philadelphia is 15 years behind where New York is, maybe Baltimore is another 10 years behind where Philadelphia is. but you can actually buy properties even cheaper than what you could get them in Philadelphia. Now, one of the reasons why we really like Baltimore is sort of the same story as, you know, Philadelphia might have to New York. Baltimore actually has to Washington, D.C. So Washington, D.C. is, you know, pretty expensive, I think, you know, for a lot of people. And you know, a lot of sort of working class and middle class families who may not be able to afford living in Washington, D.C. are coming back to Baltimore. Baltimore's 40 minutes outside of Washington, D.C. A lot of the very big government jobs are 20 minutes outside of Philadelphia and 20 minutes outside of Baltimore. So, you know, Baltimore, I think, you know, to a certain degree has gotten a pretty kind of bad rap. I mean, there are certainly certain neighborhoods in Baltimore which are, you know, I mean, you go to these neighborhoods and every single house on the street will be abandoned. And we don't really kind of invest in those neighborhoods. In Baltimore, we actually really maybe only invest in, you know, B or B plus or even A minus neighborhoods in Baltimore. But we do see, you know, not only the potential for a lot of these neighborhoods to appreciate, but also the opportunity to buy property is pretty cheap. I mean, we have properties there that start at $85,000 fully renovated, which is pretty good. And a lot of those times the rents will be $1,100 to $1,300 a month. I mean, we've had, you know, I mean, certainly in Baltimore, we typically get a little bit higher rates of return than we do in Philadelphia. I mean, on an average, we're getting about 10 to 12% returns. We do get some, you know, outliers that do more than that. We actually just sold a duplex, which is 2 apartments that has, you know, a 15% return. So you can certainly find that in Baltimore. I think another kind of you know, differential between the two cities is in Philadelphia we do primarily, I mean, only free market because there's such a demand for these properties. In Baltimore, we do a little bit more of Section 8 type portfolios. So for certain investors who want a more guaranteed rent by the government, we have certain properties that fit the sort of Section 8 model. And in Baltimore, they actually pay significantly more Section 8 than they do in Philadelphia. So in Philadelphia, you might get, you know, $1,000 or $1,100 for Section 8, where you might actually get more in the free market. In Baltimore, you might get, you know, anywhere from $1,100 to up to $1,800 a month there. So it makes a lot more sense to do Section 8. We don't do completely the portfolio of Section 8, but we do have properties that are in that kind of Section 8, you know, model. Oh, sorry, I clicked over too much. Okay, so the next, Baltimore as well, the city, the metro area, you know, the prices of properties have actually risen in the city, and there's actually a very robust home buyers market in Baltimore. So I think I went over this a little bit, but you know, basically part of the reason why we really like Baltimore is because of its proximity to Washington, D.C. and all of the, you know, major jobs that are there. Again, you know, a city that's providing sort of more affordable housing for working class and sort of middle class folks. Talking a little bit about Baltimore property management, we have a joint venture with Reveal. They are a developer and an owner of these types of properties and all sorts of different properties. I mean, they have everything from single families up to 20 and 30 unit buildings. I've worked with some of the biggest, you know, investors and developers now in all 3 cities, in New York, in Philadelphia, and in Baltimore. And I would have to say, Stefan, who runs Reveal, is probably one of the best property managers that I have ever seen, ever. I mean, he will literally chase somebody to the ends of the earth for $100. So he's a kind of guy that you want on your side managing your buildings. He has a tremendous amount of experience actually in Baltimore, and you know, we are very happy with his expertise with our clients' portfolio holdings in Baltimore. Okay, so this is an example deal of a property in Baltimore. Another thing to note, sometimes we don't do full gut renovations to properties. Sometimes we buy them and they're in such good condition that it doesn't make sense to tear down the whole house. So a lot of times we will do somewhat partial renovations, and we will also outline this for you specifically when it comes time to buy one of these properties. But this is a good example of a property where we didn't do 100% new rehab. So in Baltimore, we bought the property for about $43,000. We put about $36,500, which we basically went in there and did kind of all the major stuff, but it wasn't like a complete gut renovation because the property didn't need it. Something also to note, we very specifically, before you buy the property, we will give you a construction contract with exactly what we're doing as part of that renovation. So you go in with a full understanding of what we're doing and what we're not doing. But anyway, going back to this deal, the closing cost for this particular one was $4,800, makes $1,000 a month. So you're into the property for, I think, roughly about $85,000. And the net, I think that property rented for about $1,000 a month. And after all your expenses, you have 11.7% return. That's also, that particular property was in a neighborhood where all the similar houses are worth about 120. So basically, we were able to sell it to our clients for about 85, renovate it, put a tenant in there, and then now you have a house in a neighborhood where every other house is worth $120,000. Okay, so kind of going to sort of the next steps. Basically feel free to visit our website. One thing that I will tell you about our website and our properties go very, very quickly. They sell quickly. So we can't update the website with all of our available rental or available properties for sale as quickly as we would like to. So please do actually reach out to us, and we will actually send you a spreadsheet with all of our most current availabilities. So keep that in mind, but do go check out the website. Obviously, you can shoot me an email. My email contact is Oliver at Turnkey Property Pro. Also, you have Tom's phone number. Tom is actually sort of my second in command and doer of all things, and happy to talk and answer questions for everybody. So you have his phone number directly there, and you have as well the website. So I think that's about it, guys. I hope that I covered. It's kind of a lot to cover in a short amount of time, and I hope that I addressed as much as I can, but certainly if you guys have any questions that you'd want to sort of ask us now, or Brittany, if you have any sort of IRA direct questions that you want to ask Brittany, I think now would be the time, right, Brittany?
Yeah. Thanks, Oliver. That was great. Very helpful. I was just checking as you were talking to see if we had any questions come through. We don't have any right now. I know we have numerous people on, but it just may be that there aren't any questions at this time. So we'll try to hang for like another 30 seconds if you guys have any questions that you do want to enter in. Again, there's a question pane to the right of your screen on the little control panel that you see there. If there's anything, don't be shy. No question is a dumb question if you want to ask something. Otherwise, if you don't feel comfortable asking now, we also have shared our contact information, and you'll be receiving an email from GoToWebinar after this. And I should have mentioned it before, but the session is being recorded. So you can always reference back to this conversation, and you can also take that recording and share it with anyone that you think might be interested in listening or might want to discuss further. Actually, a question did just come in as we were talking here. What are the restrictions for personal use for a vacation property? Let me just see if this is the same. This is the first question that came through. So I'm just going to answer from the perspective of if you're talking about purchasing within a self-directed IRA, what are the restrictions? Basically, you wouldn't be able to purchase a vacation property that you planned on using with a self-directed IRA. You're not allowed to live in that property or personally benefit from it, because if you think back to the rules that we talked about, you have to be personally removed from benefiting from your IRA's investment. One option, however, is to, after retirement, basically distribute that asset out of your retirement account back to yourself. So it'd still be a taxable event, because just as if you took a withdrawal of cash out of your account, it would be taxed, after retirement, assuming that you have a tax-deferred account. But basically, you'd be able to re-register ownership of the property from your IRA back to yourself personally. So if this is more of a long-term play for you, and it's a property that you are willing to potentially rent out, or you want to purchase it now and you want to fix it up, and you can afford to have it, just there until you're ready to use it after you, take it out of your retirement account, that is an option. It is something that people have done, but it's not as simple as just, okay, I'm going to purchase a house with my retirement plan and then I'm just going to live in it, because unfortunately that would be a prohibited transaction, and the consequences of that are not worth it. So if you have more questions about that, I'm happy to talk to you offline. There's another question that came in. Sorry, Oliver, did you want to say something?
No, I just, from a real estate perspective, I just wanted to add on, we don't do typically vacation properties. We do more rental, landlord, full year-round tenant type properties. So just as a side note, we don't really, not to say that vacation rentals are not good, but, we kind of focus on more year-round dependable income from, at least our business model. So I wanted to just add to that.
Sure. Yeah, that makes sense. Thank you. The second question, I think it's the last one for tonight that we see here, is there a benefit to doing it this way if you don't already have an IRA? So the short answer is probably not, but the longer answer is, we would need to have a conversation to understand what other funds you might have, and whether you're self-employed and what type of IRA you might be able to open. If you don't have an IRA, but you have an old 401k, remember that's an option you can leverage. So you can roll over an old 401k into an IRA. And so that means if you're not self-employed and you've worked for a company in the past that you've contributed to a 401k plan and now you're not employed with them, it's not an active plan, that would be an option. If you don't have that and you don't have any retirement accounts at all, the question would be, are you self-employed? If you are, you have the ability to make those larger contributions on an annual basis. And so that would be a question for your tax advisor to talk to them and say, hey, I want to open, and most likely the type of IRA, if you're self-employed and you want to make greater contributions personally to it, to add funds in there, is a SEP IRA. If you said, hey, I want to open a SEP IRA, what, based on my W-2 business income or my business income, what can I contribute on an annual basis to my newly formed IRA? Your tax advisor is the best person to tell you that, because they'll have all your records and information, and everyone's circumstance is unique. So they should be able to tell you that. So if you think that you can contribute enough that it makes sense that you can actually use those funds to do an investment, then yes, this potentially could be beneficial. If the answer to that is no, then maybe it takes a little bit more digging in to understand what the options are. So it's not quite a black and white or straightforward answer. Again, everyone's situation is different, so I think it would require more conversation and a little bit more digging to determine what the options would be. So I hope for now, at least that answers your question. And I want to thank everybody for joining. Again, whether you attended or not tonight, if you registered, you're going to receive an email with a copy of the recording. So feel free to reference back to that and reach out to either of us with any questions that you have. We really appreciate your time tonight. We hope you found this valuable.
Thanks, everybody.
We hope you enjoy the rest of your Thursday and your weekend. Thanks, Oliver, for joining us. We really appreciate your expertise.
All right.
Absolutely. Take care, everyone. Have a great night. Bye.